Imagine it's 2008 and the stock market is in free fall. Your stocks are down almost 40%. Yet one asset in your portfolio isn't crashing. In fact, it's gaining value. That asset is gold. During the 2008 financial crisis, while the S&P 500 plunged, gold rebounded and actually ended that year up about 5.5%. Over the entire 18-month downturn, gold's price rose more than 25% as stocks struggled. This contrast highlights why savvy investors often keep a portion of their portfolio in precious metals as a safety net. In today's video, we'll explore the importance of diversifying your portfolio by investing in gold, silver, and other precious metals. We'll take a quick tour through the history of gold and silver's performance, especially in inflationary periods and market crashes, and what's happening right now that has renewed interest in metals. Finally, we will explain how and why these metals act as a hedge against inflation and volatility, and also touch on other metals like platinum and palladium. To understand why metals are so valuable in a portfolio, let's rewind to some of their shining moments in history. High inflation in the 1970s is a great example. After the U.S. ended the gold standard in 1971, gold was free to trade in the open market. By January 1980, amid soaring inflation, gold hit an inflation-adjusted peak of about $3,300 in today's dollars. In simpler terms, gold went from its fixed price of around $35 in the late 1960s to about $850 per ounce by 1980. That incredible jump shows how gold kept up as the dollar's buying power was eroding in that stagflation era. And silver wasn't left behind either. In fact, silver's price spiked to around $50 an ounce in early 1980, which remains its overall all-time high price. However, it nearly hit that value again in 2011. After inflation cooled in the 1980s, gold and silver took a breather. Gold entered a long slump and bottomed out around $253 per ounce in 1999 during the strong economy of the 1990s. But fast forward to the next crisis, the 2008 global financial crash. During that time, gold held firm while stocks tanked. In the 2 years following the meltdown, gold's price surged from about $730 in late 2008 to around $1,300 by late 2010. By mid-2011, amidst the aftershocks of the crisis and fears of Eurozone defaults, gold reached about $1,825 an ounce, roughly double its price from before the 2008 crash. Let's talk about silver. Silver is more volatile, but it often rides shotgun to gold's rally. After 2008, as the economy began recovering, silver went on a tear. In 2010 alone, silver prices jumped over 80%. By spring 2011, silver was briefly back near that $50 mark from 1980 before cooling off. This huge spike showed both the potential and the turbulence of silver. It can deliver big gains in recovery periods, but it can swing sharply. The takeaway from history? When inflation spikes or markets crash, gold, and often silver, tend to shine. They won't always shoot up in every downturn, but over multiple major crises, we've seen them hold value or rise while other assets falter. Now let's jump to current events. Why are metals gaining interest again? The culprit is inflation. Over the past couple of years, inflation has hit levels we haven't seen in 40 years. The effect? The purchasing power of cash is reduced and even eats into stock and bond returns. Naturally, this means that many investors have turned to gold and silver, the time-tested inflation hedges. The numbers tell the story. Gold prices have been climbing. At the start of last year, gold was around $2,060 an ounce. By the end of the year, it was roughly $2,627. That's about a 27% jump in 1 year. Gold recently hit new all-time highs, trading above $2,900 per ounce for the first time ever. Silver has also been on the upswing, climbing more than 20% in 2024 alone. And it's not just individual investors. Big institutions and governments are buying too. In 2022, central banks around the world bought over 1,100 tons of gold, the largest annual haul on record since at least 1950. Why would they do that? Geopolitical uncertainty and high inflation. When the folks managing countries' currencies are loading up on gold, it's a strong signal that gold is seen as a stable store of value in uncertain times. The past few years have been full of uncertainty. A global pandemic, war in Europe, supply chain chaos, and even banking scares. All of this shakes confidence in the usual places like stocks or even bonds. This gives gold safe haven appeal and makes precious metals very attractive again. So why do investors call gold and silver a hedge or insurance for your portfolio? It comes down to their unique properties. First off, precious metals are finite and tangible. You can't print gold like a central bank prints money. There's only so much of it in the earth. Gold's limited supply and indestructible nature mean it's historically held its value over the long run. In contrast, paper money can lose value if there is too much circulating. So, when the prices of everything are rising and each dollar buys less, gold often increases in dollar price, keeping up with the cost of living. Gold also functions as a safe haven. It tends to thrive when other assets are in turmoil. If people lose faith in the stock market or are worried about a recession, they often move money into gold. It's recognized and valued everywhere in the world. Its value doesn't depend on any one company or government's promise. Gold often rises when confidence in other assets declines, especially during times of high inflation, economic uncertainty, or geopolitical crises. This inverse relationship is what makes gold an effective hedge. It zigs when stocks zag. Silver shares many of gold's qualities. It's a hard asset, it has intrinsic value, and it can't be manufactured out of thin air. It's also been used as money historically. During inflation or crisis, silver often climbs alongside gold. But silver has an extra twist. It's heavily used in industry. That means silver's price can be influenced by economic activity. If the economy is booming, industrial demand can boost silver. But in a recession, that demand can drop. This makes silver more volatile, however it often follows the same general trend as gold. From a portfolio perspective, the greatest benefit of having gold or silver is diversification. These metals don't move in perfect sync with stocks or bonds. In fact, they often have low or even negative correlation with the stock market. That means when your stocks are sinking, your gold might be going up, or at least holding steady. This helps smooth out your overall portfolio performance. Think of it like shock absorbers for your investments. Gold's job isn't to beat the market in a bull run, it's to protect you when the bear runs show up. The goal of holding metals isn't growth, it's resilience. Knowing that, a modest allocation to gold or silver can make your portfolio stronger and more balanced. Let's also touch on other precious metals, platinum and palladium. These two are rarer than gold and have high intrinsic value. They're used heavily in industry, especially in catalytic converters for cars. That means they have different demand drivers than gold and silver. Currently, their prices are actually lower than gold's. Platinum and palladium have been around the $950 range per ounce compared to gold over $2,000. That lower price makes them more affordable entry points for investors. And because they move differently than gold and silver, they can add even more diversification to a portfolio, strengthening it further. When it comes to these secondary metals, however, be cautious. These metals are more volatile than gold and silver and less liquid. Because their value depends on industrial demand, their prices can shift quickly. They also lack the centuries-old reputation that gold or silver have as money, so while they're interesting options, most investors choose to treat them as a smaller slice of their portfolios. We've covered a lot in this video, so let's wrap it up. Gold and silver can be powerful tools to hedge against inflation and market volatility. They have even proven themselves during some of the worst economic storms in history. However, they won't always outperform traditional investments like stocks or bonds, but they are essential safety net in protecting your portfolio. One thing to keep in mind, middle-aged investors benefit the most from diversification into metals, and overall it can be a smart move to provide security to your portfolio. However, a word of caution, don't go overboard. A small allocation, around 5 to 10%, is all you need to make a real difference. The cool thing about precious metals is that you can invest in physical bullion, like coins or bars, or through financial products like ETFs and gold IRAs, each having their pros and cons. Physical metal will give you that real sense of security and tangibility, however you will need to store and insure it. Gold ETFs are better if you don't want to store physical precious metals, making them more convenient for investors, but you cannot hold them in your hands and feel the security. So what should you do? Evaluate your current portfolio and consider if adding some gold or silver makes sense for you. Look into ETFs, bullion dealers, or talk to a financial advisor. Remember, the goal isn't to abandon your current strategy. It's to strengthen it with a time-tested hedge. Investing in precious metals is about peace of mind. It's about knowing that if inflation shoots up or the market crashes, part of your wealth is in something solid. Gold, silver, platinum, palladium, these have stood the test of time. Consider giving your portfolio a little golden or silver boost. It just might help you sleep easier. Thanks for watching. If you found this helpful, hit that like button and subscribe for more insights on investing and wealth management. And I'll see you next time.